Well, thanks for having me on. It's good to be back. Well, I think it has actually had a pretty significant impact. So it's been quite an eventful quarter if you think about it. It started with a lot of volatility throughout summer in July and into August. And then you had the speculation on whether we were heading for a soft landing and whether the Feds would cut, and which they eventually did in September by 50 basis points. And so what I think you've seen from our numbers is that it's sort of the tide, with the tide, a rising tide, all boats rise, right? And so you saw a very broad increase in the stock markets based on lower interest rates, essentially.
And going forward, as we are watching several central banks announcing further rate cuts, how much do you think this is likely to have an impact on your portfolio in the remainder of this year? As we see the Fed, the ECB, the Bank of England, all of them cutting rates.
Yeah, it depends on how much is already priced into the market, right? But I think it's been long awaited that, as inflation has come down, as unemployment hasn't risen dramatically, it looks like the central banks and the Fed in particular is heading for a soft landing, sort of. And so I think it would be, expected in the markets that, you will have further rate cuts. And so it shouldn't be a big surprise to the market, and hence no big impact either.
I would also like to understand, however, what changed in your day-to-day positions, really, because when we heard from the Fed in September, they did surprise the markets with a jumbo rate cut. To what extent that actually changed your mindset in terms of the positioning of your portfolio?
No, I don't think it has changed our positioning at all, really, because, we are a truly long-term investor. We take the long-term view. We have, as a starting point, 70% of our portfolio in global equities and 30% in global bonds, and then we add real estate and infrastructure. But we kind of look through the short-term volatility. That's one of our strengths, right? And we don't do too much top-down, either positioning on asset classes, nor geographies, nor sectors. It's much more of a fundamental bottom-up portfolio when it comes to how we implement it.
Trond, I always enjoy reading about how you're thinking about some of the sectors, what sort of positions are perhaps the best ones in this macroeconomic context. One of the things we have witnessed recently in Europe, and until recently, let me know if that has changed, you held some UBS stock. How are you looking at European banks at this stage amid a lot of conversations around potential mergers within the sector?
It's an interesting time, right, with the Commerzbank and the Unibail situation. In general, what we've seen, and this goes also for European banks, with the, at least in the US, with the less inverted yield curve, more of a flattening yield curve, and potentially even eventually a steepening yield curve, that's absolutely a big tailwind for the financials and the banks in particular. So we kind of look optimistically at the banks in general, in global, but particularly if there is, we'll have to see how this situation in Germany unfolds. But there is definitely room for consolidation in the banking sector in Europe.
So does that mean that you are bullish on the European banking names, even though we are seeing the ECB cutting rates at this stage?
Yeah, I think so. Yeah.
Let's move on to another sector. I would also like to get your thoughts on tech. It has been such an interesting year for the sector. Where do you think we go from here between now and the end of the year, as we witness naturally further changes to monetary policy? Is this still the right time to look at tech with a bullish perspective?
Oh, that's the difficult question, right? Because tech has had such a phenomenal ride. I mean, on the back of all the hype, let's call it hype, about AI. So, I think it's a situation where you need to be maybe a little bit careful. These companies, they're large. Yes, they have, pretty robust earnings. They have a lot of cash, not least, sitting on their balance sheet, so that makes them robust. But, you also have to admit that, these are companies that are priced for even further growth, right? So you have to see economic growth, sales growth, even increasing margins to really defend the pricing level that you see these days.